Hi everyone. As we move into the 7th recession that I've sold in my 44 years of professionally selling real estate, people want to know, is this a replay of the 2008 housing crash? And I'm going to show you why it's not. Hi, Joe Kehrig with the Kehrig Real Estate Team, and this is your San Ramon Valley update for the week of September 1st. So let's take a look at our slide starting off number one. What's happening in the current real estate market? Well, first off, we did see a couple weeks ago a big increase in the mortgage rates, 0.5%. But for the most part, it stayed pretty steady. But what we're seeing, the Federal Reserve just last week came out and said, hey, listen, because what they're doing isn't working. It's not curbing inflation. So they're basically saying that, hey, we're going to keep hiking the interest rates. Now remember, when the Federal Reserve hikes the interest rate, it doesn't directly affect the mortgage rate. So when you see the next increase, chances are you're not going to see mortgage rates move a whole lot because they've already baked that in with the increase that they just did last week. So when you look at this chart and you look at it, you can see that basically going from January to here, it's kind of stabilized. Now the 4.99, like I said, a couple weeks ago, it did take an increase. So now we're dealing with more like 5.25%, 5.5%, but for the most part, the last couple months, the last 2 or 3 months, it stayed pretty steady. The National Bureau of Economic Research, because there's still verbiage out there that we're not in a recession. Well, a recession is defined as 2 negative quarters of the GDP, and we've had those now. It's just they're manipulating the words, but for the most part, the way we used to track recessions and define recessions, we are in a recession right now. And like I mentioned, the 7th recession I've seen in my 44 years of professionally selling real estate, and you can see them here going all the way back to 1949, where all the quarters, and then all of a sudden we have 2 negative quarters, and for some reason they're not calling it a recession. But you can see over the last 12 recessions, that is basically how they defined it. So we are definitely, whether they want to admit it or not, we're in a recession. But let's talk about it, because a lot of times people automatically think, okay, you're in a recession. How is real estate going to be impacted by a recession? And again, you've seen this chart I've shown you before. The last 6 recessions, which I've sold in, 4 of those 6 recessions, you can see that the real estate market has actually gone up. And in 1991, it stayed about the same. It was only during the housing crash of 2008 where you saw a huge decrease in prices. And I'm going to show you why we're not going to see that again this time. You know, it talks about over the last 5 recessions, mortgage rates have fallen an average of 1.8 percentage points from the peak seen during the recession to the trough. And in many cases, they continue to fall after the fact, as it takes some time to turn things around even when the recession is technically over. So that's from Fortune magazine. So what they're kind of saying, and what we've talked about it before, people are talking about, oh my God, the rates are high. Well, I'm telling you right now that don't be afraid of looking at adjustable rates. When I say adjustable, there's no more of those 1-year adjustable rates out there, but there's a 5-year fix and a 7-year fix, because they expect this recession to last a couple years. They say whatever the Fed does, it takes effect 18 months down the line. So certainly within 2 to 3 years, you're going to see us starting to work out of this recession. So what they're saying is when we work out of the recession, interest rates, they lower the recession, they lower the interest rates to bring us out of the recession. Where right now, when they drive you into a recession to curb inflation, they are basically raising the rates. So we're going to see the rates come down as we go out of this recession that we're currently in right now. Why the housing market won't crash? Well, number one, there's not enough homes on the market. The bottom line is you look at supply and demand. And as we talked about, over the last 14 years, they haven't built 6 million homes that they normally would have built. Then you can see from this chart, there's just not enough homes for sale right now, way below average. People talk about foreclosures. Well, foreclosures, if you've owned your home for a year, you've gotten so much equity built up that unless you just pulled it all out, you don't have a chance of being foreclosed upon. And you can see this from the housing crash all the way to now, that foreclosures are almost non-existent. Matter of fact, the experts say that if every home that was behind in their payments came on the market, it still wouldn't even put a dent on the inventory out there. So you don't have to worry about a lot more homes coming on the market with foreclosures and short sales like they did in 2008, 9, and 10. So that was one of the things that we had to look at. What's ahead for 2022? First off, when you look at the mortgage rate projections and you basically see Freddie Mac, Fannie Mae, Mortgage Bankers Association, NAR, and the average of all four, they expect right now it's about 5.5, 5 1/3, and they expect it to start settling down a little bit because remember, the banks bake in the higher rate. So as the Fed raises the rates, it doesn't automatically mean a higher mortgage rates, and they're actually expecting things in the next year to settle down to around 5%. Now people say, yeah, but it was 2.5%, 3%, Joe, at one point. Hey, you know, that was like fantasy land. You know, 5% is the new normal. It's like going out and getting gas at $5 a gallon. That's kind of the new normal. You're not going to see $2 and $3 a gallon gas anymore, just like you're not going to see 2.5%, 3% interest rates. So again, when you look at the history of interest rates, it's still such an attractive rate. And when you look at the existing home sales in this chart, you'll see that they're projecting 5.1 million closed sales this year. Well, except for last year when there were 6.1, you look at 2017, 18, 19, and 20, it's pretty normal. So we're in a pretty, and during the 17, 18, 19, that was a seller's market also, just not like last year where it was just pretty much nuts. And they talk about 3 reasons why you should be a buyer. If you listen to our last video, we talked about why you should be a buyer in this market today. Well, number 1, there's fewer multiple offer situations. You don't have to get in bidding wars. There's fewer homes selling above asking price. And the supply of the homes is growing a little bit, but wait till you see the charts this week and what's kind of happening with the market. But right now, if you're a buyer right now as we get towards the end of the summer, there's a lot of inventory out there. And people go, well, I'm going to wait a couple months and maybe inventory will go down in November. Well, it might, but you got to remember, the inventory that's on there in November, for the most part, is what no one else wanted during the summer. So right now you can go out there as a buyer and not only maybe knock the price down a little bit, not get in the bidding war, but you actually have a pretty good selection of homes to be able to purchase. So let's dive right into our graphs for the San Ramon Valley. And one of the things that you'll see is, if you remember when we were in the height of our market, 4 or 5 months ago, active properties were here and pending properties were here. Well, when we went through that correction, remember, a correction is anything where prices, drop more than 10%. And in San Ramon, they dropped up to 20%. Danville, Alamo, 5 to 10%. But we saw inventory go from here, pendings here, a complete inverted over a 6-week period. Why did that happen? Well, that happened because it was a perfect storm. As we went into the summer, we had all the new inventory coming on the market, and they jacked up the interest rates at the same time, and it just completely stalled the market. Then what did we see? We saw the market kind of stabilize. We saw that inverted where basically now pendings went here and actives went here. But what have we been seeing the last 6 weeks? It's kind of been amazing now. Look at San Ramon. Look at the inventory, and when you look at the inventory, it's going down, 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 and pending's going up and up and up. So actually the market is closing back down a little bit. In San Ramon, Danville, pretty stable. Active properties have stayed about the same, pending properties have stayed about the same, but again, it's much better than it was a few weeks ago as far as less inventory and more pendings. Blackhawk has stayed fairly stable over the past 6 weeks. The Alamo market has stayed pretty stable. So Alamo, Danville, and Blackhawk has stayed pretty stable because it didn't have huge increases, huge decreases like San Ramon and Dublin. Well, when you look at Dublin, it's the same thing as San Ramon. Active properties have been going down, 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 and pending properties have been going up. So what is the market telling us? Well, we were in a crazy, stupid market, for the first 6 months of the year. Then it did a correction. Interest rates went up, more inventory came on the market, so the higher interest rate took away some of the demand. The more homes that come on the market normally as we go into the summer added to the supply, so a completely inverted supply and demand. Now, since that time, we saw a stabilization, and now we're actually seeing it back off, where inventory is now starting to go down because people are putting their homes on the market right now, and they're not going to be in the next couple months. But again, there's still a lot of inventory out there for potential buyers. As you can see, there's more listings than there are pendings. Now, when we look at the stats, you'll also see that we're down in the 90 percentile. We have been basically the last 3 or 4 weeks. San Ramon selling at 98% of asking. Danville popped to 102%, Blackhawk 91, Alamo 94, and Dublin 98%. So we're going to stick around 95, 98%, for the most part. But realistically, remember, when a price drops, if a home's at $2 million and it drops to 1.8 million, and then it sells for 1.8, it's going to show 100%. So in reality, if you looked at actually where these prices started, we're probably down between 90 and 95% of where the asking price started to what it's selling for right now. So again, we're seeing a shift in the market. We were seeing 10 to 12 price reductions a day in the San Ramon Valley. Now we're seeing 3 or 4 a day. So pretty soon the market's going to even out. We're going to have what we call basically a transparent market. And transparent market, I guess, is what you would call normal market. If a home's worth $2 million, we're going to list it for $2 million. It's going to sell for around $2 million. If it's $1.5 million, same type of thing. So that's what we call transparent pricing. But always remember, if you're thinking about selling or buying, reach out and give us a call, because every neighborhood, every city is a little bit different. And it's more sitting down and figuring out, hey, does this make sense for you to move right now? Does it make sense for you to purchase a home? We can't carte blanche sit there and say, hey, it's a good time to sell, it's a good time to buy. We have to sit down and see what your plans are, what your goals are. So give me a call. Again, Joe Kehrig with the Kehrig Real Estate Team, 925-487-6838, or drop me an email, joe@kehrigteam.com, or visit our website to see all of our listings and learn more about the Kehrig Team, www.kehrigteam.com. Can't wait to see you next week, and again, reach out with any questions.